All right, traders, George here, and I just want to highlight what we'll call the trade of the week. For the S&P on the hybrid chart that I've been showing in the live room, one of the nice follow-throughs that we saw was this breakdown below 2102s here. We had a sell impulse and an outside return, and when we saw price break below this balance beam here, we were on the lookout for a one-to-one symmetrical move, and that's exactly what happened. That's not the trade of the week, however. This action right here, where we broke to some new lows, we made new structure lows down here at the bottom of the chart, breaking below 2090. We talked about this price point here as being a key commitment level with not as much trading commitment below that. So this action here is actually pretty darn bearish. When we're breaking below that and driving to new lows, letting go of the 90s and moving into the 80s, pretty bearish turn there. However, as these things go, when you're in a bullish market and you see these key support breaches like we saw here, when you see price pass back through the floor, which is what we had over here, then be on the alert for a new bull impulse. And that's where we started looking for this move up and then a continuation back over to return to essentially 2103s, and we chopped up today. But this recognition here is the trade of the week for two reasons. One is if you happen to be short here and you didn't cover over 90s, you certainly were forced to do that at some point later on. The other is it puts you on alert to look to go long. Now, where a lot of traders will have problems is they'll be late to get into an impulse. They'll respond emotionally, and perhaps at the time they're doing this, there's also something in the news, something that makes it even more heightened, more hype around whatever the story of the moment happens to be. And as this starts to happen here, they've gotten in so late that they're underwater in a hurry. So essentially at some point they're moving from pain to pleasure. The pain is staying in this position where they had some gains, they're now underwater. They can't believe it because the quote-unquote news was so bad. And the next thing you know, they have to move from pain, which is looking at the losses, to pleasure, which is being flat. Then they might try to short it again because that's what they wanted to do originally, and they have to do the same thing again. So rather than recognizing where they should be going long, or if they happen to be short and covering, they're essentially magnifying the losses that they're getting out of this price action. So at the end of the day, these balance beams, being a buyer above and a seller below, they happen to be areas where traders typically will say, if I only did the opposite, I would have made money. Traders that instead of going short here and went long, ditto for longs that were buying the break here. All right. They did the opposite, they would have made money. And the motives for traders to react to these areas, very psychological and really driven by a lack of rules. So when you have a repeatable visual occurrence that you can pull off of a chart like we do here off the balance beam model, it really helps put you on track to be part of positive expectancy with your trading. We had a great week in the live room. Despite my voice, we'll be doing some training tomorrow, looking forward to that. But I just wanted to give you another review here of this key price move in the S&P back over 2090. That's going to be your trade of the week. We'll see you back in the live room.